Good evening, class, and welcome to our performance management class for today. We have been discussing the topic advanced variance analysis. So that's where we are since the last class. Okay, so we talked about sales volume and volume sales volume mix and quantity variances, right? Then we also went into something called planning and uh, operational variances. And I gave us a particular um, formula for us to determine how to know your planning and operational variance. We now want to look at where we stopped the last time. We stopped here and we're about to do practice question 3. Redco manufactures product K, which at the start of the budget period had a standard direct labor cost per unit of 0.3 hours per unit at 16 naira per hour. Now this is the standard. Due to an unexpected pay agreement with the direct labor employees, the standard rate per hour is revised to 20. So what changed here is the rate from 16 to 20. The number of hours, we have not heard about it. In addition, since the pay rise is linked to a productivity agreement, the standard time per unit of product K is reduced to 0.25 hours. So this has also changed. Now, the revised standard labor cost for product K is therefore 0.25 hours times 20 naira per hour, which gives us 5 naira. Actual output during the month is 10,000 units of product K, and this took 2,600 hours to make. The actual direct labor cost was 51,600. Now analyze the total direct labor variance into operational variances and a planning variance. Okay, so now we are just going to do a planning variance and operational variances. So what do we do now? This is, let's use this. This is practice question 3. Now the question here, the question is Redco. That's the name of the question. Let me just put Redco here. So you know here that we have our standards, then we have our actuals, then we have our revised standard. Okay, so when you want to do planning variance, it is between standards and revised standards. When you want to do operational variance, is between revised standards and actual. So it means we are going to be modifying our formulas in such a way that we'll be looking at where we see when we are doing planning variance, wherever we are talking about actual, we replace it with revised standards. Then when we are looking at operational, that's for planning, we replace anything actual with revised standards. Now when we are looking at operational, we replace anything standards with revised standards. So that's how we're going to be looking at it. So let's look at what we are given. We are given standard. Let me say standard. Then we'll say standard hours is 0.3 hours. So we'll say standard hours 0.3 hours. Standard rate. We are told that standard rate is 16 naira per hour. 16 naira per hour. Okay, so we can just say something like this: 0.3 times 16, which gives us 4.8. This was given to us. Then we'll say revised revised standard. We are told that standard, okay, revised standard hours is 0.25. Revised standard rate is 20 naira per hour. So it's something like 0.25 times 20, which is something like 5 naira. That's what we were given. Then actuals. We'll now bring our actuals. Actuals. Then what were we given? 10,000 units. 10,000 units. What again were we given? 2,600 hours. 2,650 hours. 2,650 hours. And what again? 51,600. 51,600. So we've gotten that. So these are what was given to us. Then planning. So let's say A, planning. Okay, let me not just say planning. So we'll say this is direct labor, direct labor planning variance. Okay, so Normally, before you divide it into planning and before you divide it into planning and operational, you need to quote the basic formula. You will say basic formula, that's a direct labor variance. It's normally standard as standard rate minus actual as actual rates. That's the normal direct labor variance. We are not told to divide it into rates and efficiency variance. We're just told to give just one variance, which is the total. So you now say planning variance. The planning variance, I'll just say direct labor planning variance will now be, we said in our planning variance, we replace actuals with revised standard because it is between standards and revised standard. So it's going to be standard as standard rate minus revised standard as revised standard rates. All right, so what is our standard as? We are told it is 0.3 for 1 unit. And what is the actual production we made so that we know the standard hours it will take to do that unit? We made, is it 10,000 units? Let's check to be sure if it is 10,000 units. Yes, 10,000 units. Then what is the rate? The rate we said it was 16 naira. Just to confirm, 16 naira. All right. Now minus, what is the revised standard? 0.25 multiplied by 10,000 multiplied by this is 20. Of course, somebody could use, instead of using all this 0.3 times 16, somebody would have just said 4.8 times 1,000 minus 5 naira times 1,000. It's the same thing that you're going to get. Okay, so now let's break it down. Already 0. Here's my calculator. Already 0.3 multiplied by 16. We know it's 4.8. Now 4.8 multiplied by 10,000. Sorry, that should give us 48,000. So that should give us 48,000. And we know that 50 naira times 10,000 is 50,000. So it means that your planning variance is 2,000 adverse. So your planning variance should always be an adverse. That is because there is a problem with the um, budget, and so because of that, it makes you as if you're having inefficiency of up to 2,000 naira. All right. So you don't need to start dividing it into rate variance and efficiency variance. You are not going to use it to do anything. So it's just good to know the total planning variance. Now let's go to operational variance. So we come here, D direct labor operational variances. Okay, so we'll start with the basic formula. So we have direct labor variance. We know that it is standard as standard rate minus actual as actual rate. Then we know that direct labor usage variance. For usage variance, we know it is standard as standard rate minus actual as standard rate. Okay, so now let's look at the usage first. Then you will say operational variance. So direct labor usage operational variance will be, I said operational is between revised standard and actual. So wherever you see standard, you change it to revised standard. So it's going to be revised standard as, this is standard rate, becomes revised standard rate minus, this is actual hours, it remains that way. Standard becomes revised standard rate. So that is for operational. So what is our revised standard hours? Revised standard hours happen to be 0.25. Then we have 10,000 units, and we had the rate is 20 naira. We've established that this already is 50,000. We've established that. Now minus actual hours. And the actual hours it took us was 2,650 hours. So this is 2,650 hours. Then revised standard rate is this 20 naira. So this is 20 naira. So what will that be? Bring our calculator now. 2,650 multiplied by 20 gives us 53,000. So this is 53,000. Okay, so what it means here that this is going to give us 3,000 adverse. This is 3,000 adverse. So operational usage variance, it means that the operational manager is not that efficient. He didn't use it well. Okay, this is labor. Okay, so the HR, they perhaps they hire more people, they pay more in labor than expected. Perhaps they hired higher grades of labor than what they planned. It could also be that the labor wage increased more than they anticipated. Now let's go to um, rate vary. Okay, no, this is usage. Why am I calling it usage? Efficiency. Sorry, it's not usage. Efficiency. Don't know why I'm calling it usage. Direct labor efficiency. So it means that they use more hours than what they should have used. They didn't use the hours efficiently. So if you look at it here, this is 2,650. This is supposed to be 2,500. You multiply 0.5 times 10,000, it's supposed to be 2,500. So the standard that is revised is supposed to be 2,500 hours, but they use 2,650. So they are not efficient. And that cost the company 3,000 naira more than it's supposed to. So it means that the production manager or the supervisors did not, I don't know what I will say now. Maybe they hired people who are less skilled than what they need. And so it took them more time to supervise. It could also be that they had to work to supervise them, had to rework some of the things that they did. And you will see that in the rate variance, you'll be having a favorable variance, which is far more than this 3,000, which will suggest that they hired cheap labor and it's giving them adverse operational efficiency. So, but let's go down to efficiency variance and rate variance. So we say direct labor rates rate variance. Normally we say it is um, the rate variance is supposed to be actual hours standard rate minus actual hours actual rates. Okay, so when we now call it direct labor rates operational variance, so it is between standard, revised standard, and actual. So this is actual as revised standard rate, which is exactly what we have here that gave us 53 minus actual hours actual rate. Okay, so we've calculated this before, and this gave us 53,000. Then how much did we spend? 51,600 is the actual thing we spent. So we're supposed to spend 53. We now spent actually 51,600. Okay, so let's see. 53 minus 51,600. That gives you 1,004. So 1,400 favorable. So the gain that they got in the rate variance for hiring cheap labor, they now paid dearly with the efficiency that they were not able to do good work, and that's issue for them. So if you are to total the two variance, so if you are to check total direct labor operational variance, the same thing as direct labor efficiency plus direct labor rate. So we have here 3,000 hours plus 1,400 favorable. So that will make it, let's see, favorable minus adverse. That will give you 1,600 adverse. All right, so let's check. So we say check. If we are to do operational variance directly, direct labor operational variance is supposed to be revised standard hours revised standard rate minus actual hours, actual rate. So our revised standard hours, revised standard rate, we'll get it from here. Revised standard hours, revised standard rate is 50,000. So no need to calculate further. This is 50,000. Actual hours, actual rate, got it here, 51,600. So let's put it down here, 51,600. So when we say 50,000 minus 51,600, and we get our 1,600 adverse. So 1,600 adverse. So you see why I call it a check. You are checking to show that the sum of your direct labor rate and efficiency variance, what it gives you when you add them, is the same thing you will get if you do it directly. This is the total operational variance, but it's subdivided into these two. And that's it for this question. Someone is asking, somebody is asking, I said it before, why didn't we do efficiency and rate variance for planning? We can do that, but it is not needed. The questions say here, analyze the total direct labor variance, that is the total, into operational variances, this is plural, and a planning variance, just one. So we don't need to do efficiency and rate variance here because we just want the total, because we're talking about total planning variance. But instead of doing total efficiency variance alone, total operational variance, we need to subdivide it into these two. Secondly, I mentioned that planning variance cannot be useful to management. They only tell you that there is a problem with the original budget. So no need calculating the efficiency and the rate variance. No need, because you cannot pin any problem on the management. But with operational variance, you will know who to apportion the blame to. That's why we need to subdivide it into two. So that's it. So we've done practice question number 3. And before we go into this, we have a question here, November 2015, question number 2. So let's go down there. November 2015. So this is I can pass question. I can pass question. November 2015, question number 2. Right, I have it here. November 2015, question number 2. This is Pestel Limited. So let's go here, call it Pestel Limited. Now, in all variances, they will be giving you standards first, then they will give you the actuals later. If it comes to advanced variance, you will see the standards first, followed by the revised standards and the actuals. So let's start with what we are given. So this is what we are given. Pestel Limited produce cake and bread, which it supplies to its major supermarkets in Abuja. It holds no inventories because it adopts the just-in-time system. the standard cost of wheat used for making the products. So it means wheat is used in making bread, wheat is used in making cake, is 200 naira per kg. So we'll come here. So I will say this is bread and this is cake. So we'll say standard price, we'll say 200 naira per kg. Same thing here, 200 naira per kg. Each piece of cake uses, so we say use standard quantity. So we'll call it standard quantity. So I'll call this is SQ, this is SP. Each piece of cake uses 0.5 kg of wheat, 0.5 kg, 0.5 kg. Then, while each loaf of bread uses 2 kg of wheat, this is 2 kg. So we have our standard quantity, standard price. So given the standards, let's see if we are given the revised. Production levels for the cake and the bread for the month were as follows. Production, let's say actuals now. Let's go to actuals. Actual. Okay, this is budgeted. This is actual. So let's start with budgeted first. And they say not just in time means everything they produce, they sell because there is no opening and closing stock, no inventory. So I will come here. This is budgeted. So in budgets, budget is taken from standard. So I will say budgeted quantity. Okay, for bread is 240,000. So this is units, 240,000. Then the other one is 380,000, 380,000, 380,000. Okay, then we will go for the actual. This is, sorry, this is going to be actual quantity, also in units. 240 steel and 360. So this is 240 and this is 360. The actual cost of wheat in November, so actual cost of wheat. So we say actual price. So I can call this one actual quantity. This is budgeted quantity. Actual price, this is AP. How much is the price here? 232 kg. 232. Sorry, 232 naira per kg. So I'll come here. 232 per kg. Since it's the same weight, it is 232 per kg. Then we read on 4,000. Okay, so that thing I wrote here is not actual quantity. This is units. So just leave it there as units. Leave them there as units. So I will come here, actual quantity. This is AQ. So actual quantity here, 496 kg of wheat was used to make bread. 496,000 kg. This should be 190,000 kg. Let's check. And 190,000 kg was used to make the cake. Used to make the cake. Then we'll go to revised standards. Revised standard. Revised standard. Now, the global prices of wheat increased by 18% in the month. The global standard increased by 18% in the month. At the beginning of the month, the supermarket group made an expected request for an intermediate shape change to the cake, resulting in 5% more wheat than previously required. So it means that at the beginning of the month, the supermarket made an expected request for an intermediate change shape to the cake, resulting in 5% more wheat than previously required. So standard quantity, quantity, revised standard quantity for the cake is going to now be, because they said 5% more than previously, so it's going to be 1.05 multiplied by 0.5. So this is the normal quantity, which is 0.5. If you are going to be making it 5% more, so this is 1 is 100%, 0.5 is 0.5% over 100%. So when you multiply this, so we'll just put it this way. This is the revised standard quantity. Okay. Then let's look at what else. This change, this change also brought about production delays, which caused a reduction in production by 20 units of cake in that month. So you can see why we budgeted for 380 and the actual was 360. Because of the delay, they reduced the quantity by 20,000. The production director is given the task of purchasing relevant input material and any production requests which occur, although it does not take responsibility for setting standards. For setting the standards is management, and so if there is a planning variance, it's not his responsibility. So they didn't say anything about bread. So we'll just go here and repeat what we have for bread. Revised standard quantity will still remain 2 kg, meaning that there is no revision. There is no revision. Then revised standard price. Revised standard price. We are told, I skipped it before, global prices of wheat increased by 18% in a month. So it means that when you are planning your revised standard, you need to increase it by 18%, meaning that your price of wheat will now be 1.18 multiplied by what's the normal standard price you had before. You had 200 as your standard. 200. So this is the same thing, 1.18 times 200. Now we have all the data that we need. Now that we have broken it down like this, you will now start taking the whole thing. So we are asked to do something. Compute the following variances for the month of October for each of the following products and in total. In total. So material price planning variances. So you see here, the person that was asking me, why did we do one? They said variances. Then after doing material price planning variance, we do for bread, we do for cake, we will now find the total and add them. Material price operational variances, usage, and all that. So let's start our work. So required price and usage planning and operational variances for both bread and cake and total. So that's what we are going to be looking at now. So the first one here is A. What's the A here? Material price planning variances. Material price planning variances. Normally, you quote the basic formula for for price variances. So we know that basic formula here, direct material cost, it means this is um, actual actual quantity standard price minus actual quantity actual price. That's for price variance. So you can see the prices are different. So we will not say planning variance. Okay, planning variance, it will not be for planning where you see actual, replace it with revised standard. Where you see, because it's between standards and revised standard. So anywhere you see standard, leave it that way. There is no actual in planning variance. There is no actuals. So here becomes revised standard quantity. This is standard price minus revised standard quantity, revised standard price. So we'll be doing that for cake and for bread. So we can now say here, this could be bread and this can be cake. So what was the revised standard quantity? Revised standard quantity, we need to scroll up. We need to make a second, I can't make a second instance of this, so I'll be scrolling up. Revised standard quantity, revised standard quantity, just a moment. Revised standard quantity for bread is 2, and this is 1.05 times 0.5. So this is like 2 kg. Yeah, this is 1.05 times 0.5. So that's the quantity. Then multiplied by the actual quantity that was produced, not the budgeted. Of course, this is 240 and this is 360. So it's going to be 240. This is 360. Then what is the standard price? Standard price of wheat happens to be something, is it 200? Let's verify. 200. That's here, standard price. So you see, it is good to break them down like this. So the time spent in doing all of this will save you a whole lot. So this is going to be 200. 200. Now, minus revised standard quantity here is still going to be 2 kg multiplied by 240. Now times the price. The price will now be 1.8 times 200. You know, global price increased by 18%. Now the same thing here. This is going to be 1.05 multiplied by 0.5 multiplied by 360 multiplied by 1.8 times 200. Okay, so we have done your revised standard quantity, standard price, revised standard quantity, revised standard price. So let's look at the first one. Why can't I see my calculator is here. Let me do the first one. 2 times 240,000 times 200. Now that gives me 96 million. So this gives me 96 million minus, this is 2 times 240 times 1 point, sorry, 1.18. This 1.18, not 1.8, 1.18, 1.18. Remember, it's 1.18 here, 1.18. 1.8 means 80%. No. So 2 times 240 times 1.18 times 200. it would have given me a very wide margin. Let's do it again. 2 times 240 times 1.18 times 200. Ah, I did division. I'll take it again. 2 times 240,000 times 1.18 multiplied by 200. 113 280. 113 280. So when you conclude, this gives you what? I'll put the minus before it, plus 96 million. Of course, I'm expecting an adverse 17 million 280. 17 million 280. So this is 17 million 280,000 adverse. I don't expect anything less than an adverse. Now let's look at that of cake. For that of cake, we have 1.05 multiplied by 0.5 multiplied by 360,000 multiplied by 200. And that gives you 37 million 800. 37 million 800,000 minus. Now, everything we did here is the same thing we are doing here. The only difference, we will just multiply by 1.18. That's the difference. 44,604. 44,604,000. Now, this is still going to give us an adverse. I expected nothing more. That gives us 6,804. 6,804,000 adverse. So I will now say total material price planning variance is equal to 17,280 adverse plus 6,804 adverse, which is equal to, so let's do that now. I'll just say, let's drag it down here. We have this in our calculator. 17,280. That gives us 24,084. 084,000 adverse. So this is the total. So you've done for bread, you've done for cake, you've taken these 4 marks. And now, let me tell you something now. I want you to know how many marks, how many minutes you should devote in a mark. You have 100 marks. And we have 3.5 hours. 3.5 hours is, okay, 3 hours is 180 minutes. Then if you add the 15 minutes, it's as good as 195. So remove that 15 minutes, remove 30 minutes out of it, take 150 minutes. 150 minutes. So what we have here is, okay, sorry, I flip it. 150 minutes first, 150 minutes divided by 100 marks. We want to know how many minutes per mark that you want to use. How many minutes per mark? So this is going to give you 1.5 minutes per mark. So this is going to be like 1.5 minutes per mark, which is the same thing as 90 seconds. 90 seconds, 1.5 minutes. So if we have 4 marks here, you have 1.5 times 4, which is 6 minutes. In 6 minutes, you should be able to do this. So, but what I would say, 6, 12, 18, 24, 30. So you can reduce it to like 2 minutes, 2 minutes, 2 minutes. The time spent in bringing down all of these things here, time spent in bringing down all of these things here should be deducted, and the remaining ones are reallocated. So just know that about 6 minutes, I should be able to do this. So what's the next one here? Material price operational variances. So I will start here. Material price operational variances. Okay, you quote the basic formula again to guide you. So by now, basic formula, by now, you should be knowing the basic formula of um, price, material, direct material price. The basic formula is actual quantity standard price minus actual quantity actual price. Okay, this is the same thing here that we did. This is price variance. That is what we want to now subdivide into by operation and planning. So you will now say operational variance. So because it is operational, operational is between revised standard and actuals. You know, in the case of planning, it was between standard and revised standard. So we'll have nothing actuals. But now in operational, it is between revised standard and actual. So anywhere you see standard, change it to revised standard. Your actual remains the same. So this is going to be now actual quantity. In place of standard, you say revised standard price. And this is actual quantity, actual price. Now that you've converted the basic to the operational, let's go. So I will come here and I will say this is cake, this is bread, and this is cake. So I will say actual quantity revised standard price. What will it be? So actual quantity of flour used in making the bread happens to be, they told us here, okay, let's just go to where we have it here. Let's go up to where we have it. Actual quantity 496, 190, 496, 190. So this is 496,000. This is 190,000. Revised standard price. Your revised standard price, we said it was 200 multiplied by 1.8. So this is 200 multiplied by 1.18. So the same thing, 200 multiplied by 1.18. Now we are saying minus actual quantity, actual price. Actual quantity, actual price. Actual quantity, actual price. Okay? Are we giving the costs? From the question, we are not told how much we spent totally. Okay? We are not told how much we spent. Okay? Actual quantity, actual price. So what is the actual quantity? Actual quantity, this is we spent 496,000 multiplied by 3232. I can remember 232 per kg. Someone will be tempted to go and use 240 units. No, this is the price per kg. Okay. Then we have here, so of course this is going to be minus. So we have here 190,000 multiplied by 3. Sorry, I keep making mistake. 232. So this will now be, so let's take them one after the other. 496,000 multiplied by 200 times 1.18. That gives me 117,056. Okay. Then the next one is 496,000 multiplied by 232, 115,072. So this will give me what? A favorable variance. One million 984 favorable. 1,984,000. So this is a favorable variance for bread. Bread has a favorable variance. So let's look at cake. How will cake fare? I have one, is it 190 or 196? Let me check again. 190, okay. I don't know why I was doubting myself. 190. Okay, somebody has calculated 200 times 1.18 is 236. No problem. I just want to do it that way so that when you're watching the video again, you'll not be asking where did you get 236. So of course, we start it like this. We say 200 times 1.18, of course, is the 236 is fine, multiplied by 190,000. That's fine. 44,840. So this is 44,840,000. Now minus 190 multiplied by 232, 44,080. 44,080. Another favorable variance is coming. 44,080, 44,840. This will give us 760,000. So this will give us 760,000 favorable. So it means that the total material price operational variance is going to give me 1,984,000 F plus 760,000 F, which will give me what? This should give me plus 1,984,000, 2,744. So this is favorable. So you see here, the purchasing manager is going to have a pass mark because the operational variance is for price. The purchasing manager, he bought at a bargain price. It has a favorable variance, but we just hope that he didn't buy substandard quality of products, because if they buy substandard quality, it may require wastage and the usage variance may be adverse, operational usage may be adverse. We also learned that there are interdependencies. It could be that the labor that was used was amateur, people that are low grade, and they will also waste a good quality material. But just let's leave out the labor. Let's just assume that the laborers are good and that if there is usage, variance, operational being in the adverse, we conclude that the purchasing manager bought substandard. So we've taken the second part of the question. So it means we've taken this. Now, usage planning variance. So let's go. Material usage planning variances. So we quote the basic formula. Basic formula. By now, you know the basic formula. This is standard quantity, standard price minus actual quantity, standard price. So the price is not an issue. The usage, standard and actual. Now, when we go to planning variance, planning variance is between standards and revised standards. Nothing of actual should be there. So it's between standards. So our standards is retained. Now, where we see actuals, we'll change it to revised standard price. So this is your planning variance. All right, so let's go. We'll now separate it. This is bread, and this is cake. So we'll start with standard quantity, standard price. Then we'll now say minus revised standard quantity, standard price. So what was your standard quantity? Remember, it was 2 kg, 2 kg multiplied by how many was done? 240,000 of bread was done. So if you multiply by 2 kg, you know the number of materials you need. The standard price was 200 naira. Now, if you go to cake, we had 0.5 kg multiplied by 360. 360 was done. Then the price was 200 for the flour. Now the revised standard, so we now say minus revised standard quantity. It didn't change for bread. It remains 2 kg. Remember that, multiplied by 240,000. The standard price is 200 naira. So you can already guess what this will be. This is going to be 0. Now, for cake, we had 1.05 as our revised standard. 1.05 multiplied by 0.5, now multiplied by 360 multiplied by 200. So this is going to be minus. So let's see what it's going to be. Somebody's still making comments. Now, this is actual. This 496,000 kg is actual quantity that was used in making the 1,000, making the 240 kg, 240 units. Now, the difference between this 496 is that is the actual. We are saying for standard, if you are using 240, if you are going to make 240 units of bread and your standard is 2 kg per unit, how much quantity should you have used? That should be 2 times 240, which should give you 480 kg. That is how we get standard quantity. So you cannot go and use 2 times 490. No, 2 kg times 490 kg doesn't make any sense. 2 kg for 1 unit multiplied by 240,000 units gives you 480 kg standards. Then the actual, they use 490. The same thing here with that 190 kg for cake. We have 0.5 kg for 1 unit. We made 360 cakes. That should give you 180,000 kg required to make cake. but actually they spent 190. So know when to use the when we are looking at standards, when we take per unit, go and bring the number of units that we are made. When we are looking at actuals, go and bring the actual quantity of input. That is when you will now bring that 490. But when we are looking at standard, we take what is the standard quantity of input for 1 unit multiplied by the number of output that was made. You will know the input that is expected. I believe that clears that. All right, so I'll do something here, something funny. 2 multiplied by 240,000 multiplied by 200. That will give me 96 million. So this is here 96 million. So I'm going to do something funny. 96 million. So that's the funny thing I'm doing. This is 0. So that's 0. It is not adverse or favorable. Then here, I have 0.5 times 360 times 200. That gives me 36 million. So this is 36 million. Now I'll do something funny here again. The difference between this one up here and this one down is the multiplication of 1.05. So I'll just say multiplied by 1.05. That will give me the next one, 37,800. 37,800. So the difference here will be 1,800,000 adverse. So of course, this is lower than this. So this is adverse. So the total usage planning variance is 0 plus 1,800,000 adverse, which is 1,800,000 adverse. So what do we expect of a planning variance? To be adverse. If you have favorable in planning variance, then there is something wrong with what you have calculated. So this will not be useful for anything for us. So we've done this. Now, usage operational variance is what we are going to be using to judge the production manager. We'll now say material usage operational variances. We'll quote the formula again. Basic. It's going to be standard quantity, standard price minus actual quantity, standard price. That's a operational. Operational is between revised standard and actuals. So it's going to be revised standard and actuals. So nothing standard will be there. So this is going to be revised standard quantity, revised standard price minus actual quantity, revised standard price. Okay, so That's what we repeat down here. This is bread, and this is cake. Revise standard quantity, revise standard price, actual quantity, revise standard price. So let's see what we can do. Revise standard quantity for bread. Bread didn't change its quantity. So here it's still 2 kg. Revise standard quantity multiplied by 240 units, 240,000 units. Revised standard price. Somebody has helped us to say it is 236. 236. Somebody is saying I should explain the operational again. Operational variance. Don't worry, when I finish, I'm going to show you how you will be doing it. After this, I will show you what you should be doing when we have planning and operational. Okay? Then in the case of cake, revised standard happens to be 1.05 multiplied by 0.5. That's revised standard quantity per unit. And we made 360,000 units. And the revised standard price, we said it was 236. How did we get that 236 again? We said 1.18, sorry, 1.18 multiplied by 200. That gave us that 236. All right. Actual quantity. What is the actual? Now you see now that's where we'll be using the 490. For yeah, actual quantity here, it is 490,000 kg. Okay. Revised standard price. Revised standard price is 236. Now your actual quantity here is 190,000. Revised standard price is 236. Now that is done, let's calculate. Variances is easy to understand and it's also easy to fail. So we have 2 times 240,000 multiplied by 236. That gives you 113,280. 113,280 minus 490 multiplied by 236. 115,640. 115 640. 640. Need to confirm if it is still 490. Don't know why I'm doubting myself. It's 190 here. 496. Let me check the first one I did. I used 496. Let me see if there's anything that calls for actual. Okay, it's here that I should start using it. 496. So I'll redo here. So what I will just do, 496,000 multiplied by 236, 117.56. 117.56. All right, it's good I cross-checked. Then the other one here is 1.05 multiplied by 0.5 multiplied by 360 multiplied by 236, 44,604. Then here, this is 190 multiplied by 236, 44,840. Okay, forgot to add three zeros in the first place here. So let's check. This is 236 adverse. Adverse here. And let's see. 113,280,000 minus 117,056,000. 3,776. 3,776 adverse. So both for cake and for bread, there is an adverse in usage. What kind of people did you employ? There might have been people that you paid cheaply, that's why we get the favorable price variance. But now we are having adverse usage. Total material usage operational variance will now be 3,776,000 adverse plus 236,000 adverse, giving us 4,012. So did you see what it cost the company? They spent 4 million more than what they are supposed to spend in usage. But for price, they spent 2 million above, they saved 2,774,000. They saved it and they now wasted it on usage. So it means that, okay, it's not employment. It means that it's either the um, purchasing manager bought substandard quality of product and it results to wastage in usage. So that could account for why there is a favorable price, substandard, adverse usage, wastage. So it's all risk of substandard. It could also be the purchasing manager got a good deal using the normal quality, got a good deal. He bought higher, big quantity, so they reduce, he got it at a reduced price. But the people that was employed are, are low grade people, and so they didn't handle them well and they caused wastage. Could be any of those. I strongly then believe here it is substandard quality of product that was used. So we have done this question, we have done it to the end, and someone will say how the operational I should take it again. So look at what I usually say when you want to do your variance. Now, your basic variance is between standard and actuals, while your planning, okay, your advance, let me say advance is between standard, then there is actual, then there is revised. So if you want to do planning first, planning is between standard and revised. So, but you will take your basic formula, standard and actuals, but in place of actuals, you put revise. Then when you want to do operational, it is between revised and actual. So you see, in all cases of advanced variance, revise is featured. So revise is featured. If it is planning, revise takes the place of actuals. Standard is there. If it is operational, revise takes the place of standard. Actual is there. So that's how you would do it. Quote the basic formula, then you change it to planning. You know, planning is between standards and revise. If the standard is there, leave it that way. If there is actuals, change all your actuals to revise. Then you know that operational is between revise and actual. So quote the basic formula, change all the standards to revise, leave the actuals the way they are. So keep practicing and you will understand. So we have taken the whole 2 hours in solving this particular question. Okay, so solved this particular question and the, the practice question. So this means that we have done this, answered this one here. Okay, so that's gone. So let's just look briefly at market share and size variance. Now, further analysis of sales volume variance. Remember when we talked about sales volume variance, we talked about mix and quantity, quantity variance and mix variance. Now, sales volume is a function of market share and market size. Now, sales volume variance, it is a function of the market share and the market size. If the original budget derives budgeted sales volume, okay, if the original budget derives budgeted sales volume, from budgeted market share and budgeted market size, it should be possible to split the sales volume variance into market share variance and market size variance. So market share variance, market size variance. We'll speak much more about it tomorrow. So, but let's just look at this note here, which we will still talk about it tomorrow. The total market size, the total size of the market is a factor that is largely outside the company's control, but it's estimated at the start of the period. So the market size, the size of the market is not in your control. So the market size is a planning variance. The market share is obtained by a company under the influence of management through marketing activities. So the market share is an operational variance. So the size of the market, you can't control the size of the market. Anybody can come in, anybody can go, size can increase. It is not your own making, it's a planning variance. But when we look at the operational activities that makes you have a large share, you have a chunk of the market, it is an operational variance. Now let's look at this example here. Colo Coloco Nigeria Limited sets the following sales budget to sell 70,000 units of product Y and budgeted to earn a contribution per unit of 20 naira. So this is what they budget to sell, 70,000 units, and they want to earn a contribution. So that is 20 naira. Coloco Nigeria Limited estimate that the total size of the market in the budget will be 700,000 units. We remember the market size, you cannot control it. They have estimated it. It budgets to have a market share of 10% or 70,000. So that is where they derive their 70,000. Now look at the actual sales in the period, 58,000 units. They were not able to sell 70,000 units. So 58,000 units. And the total market size, they predicted 700,000, but it became 645,000. In retrospect, it's accepted that the budget should have been based on a total actual sales unit. Okay, so look at what happens here. The total volume, the actual market size is 645,000. That is the actual units. Okay. Now the company sold 58,000 units and they budgeted 70,000. So it means that the budgeted, the actuals is smaller than the budgeted, and so it means there's a 12,000 naira adverse. So 20 naira contribution means that sales volume variance, the volume variance is 240. So budgeted versus the actual, 240. Okay. Now we look at the market size. The market size variance is the effect on sales volume or contribution if the actual size of the market is larger than expected, which has become favorable, or smaller than expected. The total difference between the budgeted total market size and the actual total market size is calculated initially either in units of sale or sales revenue at the standard selling price. Let's just see this example here. Market size ex ante means the original budget. They budgeted that it is going to be 700,000. The ex post, which is the revised or the actual, means they now have 645. Look at the budgeted, look at the actual. Normally, the actual should go up, projected to go down. There is a difference of 55 adverse. If there's a difference of 55 adverse and the company says they are going to take 10% market share, it means that they're having 55,500 adverse. Using the 220 naira contribution, market size variance should be 110,000. So market size variance is something that is not controlled by the company. Market size. This is market size variance. Okay, this is budgeted market share as 10%. So this is the market size variance. Market share variance. Let's look at market share variance. So note the way it is being done here. In the first one, they brought the budgeted and the actual. Now in the market share, they are bringing the actual. And we say if we were to take 10% of this actual, this is what we should be having, 64,500. But how much did we make? 58,000. So this 58 should have been up, 64,500 down. So it means there's a 6,500 adverse, making it 130,000 naira adverse contribution. So note the two ways in which it is done here. For market size, you bring the budgeted, okay, we can say bring the actual market size that's up, the budgeted market size that is down, to find the difference, then take the budgeted share of the market to find your variance for yourself. From the market, find your expected variance. This is your planning variance, 110,000. Then your operational variance is the market is supposed to be, is the market was 650.45 and you planned or you expected to take 10% from your budget. So that means you expected that you are supposed to be selling 65,500, but you actually sold 58. It fell below your expectation. So it means this is where they will use in blaming the company, 130,000. So the total market size variance and the total market share variance should add up together to give you the total volume variance. So in units for the company, this is the planning variance market size, operational variance market share, total sales volume. You can see it down here. For contribution, this is the value there. So look at the practice question and look at the alternative here. This is the alternative I would have loved to use. Market size, market share, actual market size, standard market size. Okay. Let's just do the first this practice question here. Let's do the practice question here. It said Bruno Bronco Nigeria Limited prepares a sales budget based on an estimated market size of 200,000 and a budgeted market share of 25%. The standard contribution is 40 naira. At the end of the year, it was estimated that the actual market size during the year had been 260. Actual sales were 61. Okay, so let's see the way that was used in calculating the sales variance, the volume variance the first time. Let's see. Okay, this is the volume variance that was used here from the actual market. This is what they actually sold. These were their volume budgeted to 40. Okay, so let's look at this example again and see what we can do. Practice question 4. So this is Brunco. So we are asked to look for total sales volume variance. Total sales volume variance. What is our sales volume variance? We expected actual quantity to be higher than budgeted quantity. So we say actual quantity, can now say actual price, no standard price, going to be standard price. For this time now, we want to say standard price. We can call it also standard contribution minus budgeted quantity standard price. We can use contribution margin. What is the actual quantity that was sold? The question says actuals in the year was 61,000. So this is 61,000. What is the standard contribution margin? Is 40. So I will say SP equals to SC. So I will change it to SC. So let me change this to SC, standard contribution margin. Change this to SC. Standard contribution margin is 40 naira. What is the budgeted? Now, the company budget to have 25% of the market share. So the market share was 260. So it's going to be 260 times 0.05. That is their own share times 40 naira. So now this is going to be 61,000 multiplied by 40. That gives me 2,440. 2,440 minus, this is going to be 260 multiplied by 0.05 multiplied by, sorry, I need to look that again. 25%. I don't know why I got my 5%. 25%. So I'll change that to 0.25. 2, I need to clear that. 260 times 0.25 times 40 naira. 2,600,000. 2,600,000. So this is what your contribution should be, and this is what you got. So it's going to be an adverse 2440 is 160,000 adverse. So this is your total sales volume variance. And what else are we asked to find? Market size variance and market share. So market size variance. Okay, we say actual market size. Actual market size happen to be 260, isn't it? 260. So that is 260,000. Budget market size was 200. 200. So that's 200. Okay. So your actual, let's see something here. I want to be sure that I'm doing it the way I can suggested, because it is the exams you are writing. Market size, it is the actual, this is the budget. That's fine. Doing it that way. The reason why I went back here is because seeing that I'm going to get a favorable variance, and I'm looking at it, planning variance giving me favorable. We budgeted 200, it became when it increased, it became favorable. So that's fine. So this is 60,000. Then you plan to get company's share. Okay, I want to write company share. Company's share, which is 25%. So it will be 0.25 times 60,000. Okay. Zero point 0.25 times 60,000. That is going to give me 15. So it means that this is 15,000 units. So how many did you actual? So actual company sales, actual company sales, actual company sales were 61,000 units. 61,000. No, that is not how it's supposed to be. Just a moment. Okay, this market share, market size. Okay, I should have just multiplied by the okay, should have multiplied by the by the contribution margin. Okay, okay, so this is favorable. I would say companies share, companies share, which is 25%, and we calculated 25% to be 15,000, 15,000 favorable, multiplied by contribution margin, company's contribution margin. Our contribution margin was the question. Contribution margin happens to be 40 naira. So 40 naira times 15. So 15 times 40 gives you 600,000. 600,000 favorable. Then the market share. So let's look at market share. Market share variance. I would say actual sales. Actual sales here was 61,000 units. 61,000 units. Expected share. That should be, what is the 200 and 200,000, 260,000 units was sold. 260,000 units was sold. We're expecting to get 25% on the 260,000 units. 25% of the 260,000 units. So that is 65,000 units. So the difference now is 4,000 adverse. Then what is your contribution? Contribution is 40 naira. So 4,000 times 40 naira. So 4,000 times 40. That gives me 160. So this is 160,000 adverse. So that's your 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 adverse 160. So if I were to add the two of them, so let's say market size plus market share. Market share is 160 adverse. Market size got 600 favorable. 600 favorable. So let's see what it will result to. Giving out 440. So that means we may have done something wrong here, because normally it should give us what we have as our total. Our total, we had 160 adverse. Okay, let's look at how it is being solved by ICANN, and let's compare with what we did. Okay, maybe it was me who didn't do the total well. Actual sales volume is 61. Budgeted sales 25% of 200. Let me see what I did. I did 25% of 260. That is the problem. Budgeted is different from Budgeted is from standard. I was the one who failed to use that. Budgeted is 200 here. So let's do that again. 200 times 25%. That gives me 50. 50 multiplied by 40, that gives me 2 million. So that should be 2 million. This is 2 million. Then 244, 2 million 440 minus 2 million should give me 440. So this is 440 favorable. So that should be 440 favorable. 440,000 favorable. So if we are to check what we did, and we are having 440,000 favorable, this is your sales volume. So it's correct now. So someone is asking, you should explain again. I will use the icon example here to explain. Now, we had actual sales volume of 61, as seen in my example here. 61 was 61,000 units, and the standard contribution is 40, which gives us 2,240,000, right? The budgeted is from standard. They budgeted to sell 200. The budgeted was 200. That's the budgeted market. Budgeted market. The budgeted market size is 200. And they are saying for their own company, they are going to be taking 25% of whatever the market is selling. So if it is 200 that the market is selling, 25% belongs to them. It's just like Zenith Bank is offering shares, and they said whatever number of shares Zenith Bank is offering, we're taking 25%. So these people have 200,000. They budgeted that maybe Zenith Bank is going to sell 200,000 shares. To take 25% multiplied by the value of shares, we are going to be budgeting 2 million naira. That is what they said. Then in actuality, whatever happened in the market, they went to buy 61,000. Of course, here is 50,000. When you multiply 25% of 200, that's 50,000. But now they went to get 61,000. It makes them have a favorable variance in volume. So what they planned that 25% of 200 will be their share. So it means they planned for taking 50,000. They now actually spent on 61,000. That is volume variance. Looking at it from the market size angle, the budgeted size that the budget in mind was 200. The market now came out as 260. Now, what is the difference? The difference is the actual market size is bigger than the budget, and so they are saying it's a favorable thing for them that the actual market is bigger than what they budgeted. So it means the 60,000 market size is in favor for them. If they are going to take 25% of that 60,000, it means that if there is a favorable variance in the market overall, their own company is taking 25% of that favorable variance. So 25% of 60,000 is 15. So the overall market takes 60,000 favorable variance. The company is expecting to take 25%. So 15,000 variance goes to them. And when you multiply it by the company's price, that is for 40 naira, that is 600,000 favorable for them. Market share. The company actually sold 61,000 units. Now, because when we are doing the planning before, it says when we use 260 and 200,000 budgeted. But now in market share, actual and actuals, actual sales was 261,000. Now, actual market size was 260. And if the company is supposed to take 25, it means that the company was supposed to sell 65,000 units. But what did they sell? They sell 61. So that 65,000 becomes like the expectation for them. It's like the standard for actual market size. So they have an advance of 4,000. Multiplying it by the contribution of 40 naira becomes 160,000 adverse. So adding the adverse market share with the market size favorable gives us the sales volume of 440. So that's it here. That's it here for number 4. Okay, so we have succeeded now in looking at variance, advanced variance, planning and usage variance. Okay, looked at planning and usage variance. We have also looked at, okay, we started with mix and yield, then we went to sales quantity and mix. Okay, the mix and yield is for material usage, mix and yield. Then the mix and quantity variance is for sales volume. Then we now looked at planning and operational variances. And we now broke down the volume variance. Apart from mix and quantity, we now broke it down to market size and market share. So I want you to look at what we have just done, go through the practice questions again, see the old solution I propose here, and especially try to understand the ICAM perspective. You can put it in the way I put it down here, you'll be able to understand it so much. So thank you so much. We have come to the end of variance analysis. Our next class, we are going to be taking a different topic so that we'll move forward quickly. So thank you once again for time spent in the class. I will see you again in the next class.